So with all that said, I think I'm going to hand it back over to Lucy, who is our presenter today. Lucy is a consultant with Action Sustainability over in the UK and is our resident expert in all things carbon reporting. So I'll hand it over to Lucy and yeah, to enjoy today's session.
Perfect. Thanks so much, Wendy. Good afternoon, everybody, or good morning to you, depending on where you're joining us from. For those who are on the American side of our schools, as Wendy's just said, I do sit on the other side of the pond, so got a bit of a British accent, but all the carbon principles still apply wherever you are. So hopefully, I can give you a good session on some scope busting today. Just to introduce myself, Wendy's already given me a good introduction. My name is Lucy Pickin. I am a consultant at Action Sustainability and the Supply Chain Sustainability School. As Wendy mentioned, I do specialize in carbon. I also do dabble in waste a little bit, but for today, I will be talking all things carbon for you. Few house rules that we've got today is we are on Zoom, so cameras and mics are off, but please do still get involved in our poll questions. I'll show you on the next slide, but we will be doing a quiz at the end of the session on Menti, so please do get involved in that. Please do use the chat box for any questions that you have. We are a relatively small group today, so please do feel free to answer any questions and I will answer them as we go or at the end of the session. Or equally, myself and Wendy are both more than happy to answer any questions offline after the session, should you want to follow up. As Wendy mentioned, please do share your feedback at the end. And also, we will be sharing the slides and the recording after the session. So, no need to take any too in depth notes if you don't fancy today. You can just listen along with me. As I mentioned, we will be using a Mentimeter for a little quiz at the end. It's not a rewarded quiz. You are able to get the answers wrong, and I will talk you through any wrong answers, etc. But if you do want to get Mentimeter up in the meantime, please do feel free to do this in your browser. But please don't disconnect from the webinar, as you will still need to be able to hear the session. And I will give a code and a QR code later as well to be able to join that when we get there. So a quick overview of what we're going to cover today. So first of all, we've got the concept of scopes. We're going to look at the sources of carbon as well as the greenhouse gas protocol, because what scopes mean is really important, especially if your clients are looking to understand the carbon impacts of your business, but also if you're looking to understand the carbon impacts of your business. It's important all around. We're going to look at setting organizational boundaries. There's three different approaches that we can take, and I'll talk you through these. We'll also look at setting operational scopes for carbon, talking about scopes one, two, and three, and what essentially you need to collect. And I won't go too much detail on how to collect it. We could do another session on that, but kind of just setting the scene on the different scopes of emissions. And then at the end, we've got a little bit on why we need them for reporting. Not too much, but just to kind of touch on that importance of why we should be looking into our scopes of emissions. And then finally, I've already touched on this one. We're going to do a test at the end, a little quiz to test your knowledge on scopes. But again, like I say, it doesn't matter if you get them wrong. It's all anonymous, and I'll talk you through any wrong answers so that we have a little bit more clarity on scopes of emissions by the time we finish today's session. Here we go, on to the actual content. So we're going to look at sources of carbon emissions from your organization because the first aspect really is to understand where carbon comes from. There are many sources of carbon, and as you can see from the slide now, all the activities that you do as an organization or as a business have an impact on carbon or have a carbon impact. For example, every time you burn fuel, such as petrol or diesel in your company-owned vehicles or any gas that you combust, that's your scope one or your direct operational carbon. This could also be fuels from any plant or equipment you operate on sites. This could also be biological or chemical processes that take place. It depends on what kind of organization you are. Then we also have fugitive emissions. So this is from the likes of unintentional leakages of gases from heating, ventilation, and air conditioning units as well. So our HVAC systems. So any unintentional leakages from our refrigerants are our fugitive emissions in our processes. And you also may be an organization that emits the likes of methane from composting or anaerobic processes. So these all fall under our operational carbon as a business. Then we have our suppliers as well. So as you'll note, these are organizations that you are paying to receive either a service or a product. And as you pay for these transactions or the product or the service, you are then indirectly responsible for the emissions associated with that. For example, any materials you buy, any utilities such as waste and water, they'll all fall under your supplier side of carbon. This category is sometimes referred to as embodied carbon or capital carbon as well. We hear embodied carbon more though. But then we have the clients and customers who are the opposite side to where our suppliers sit. And this is essentially the carbon that is associated with the product after you've passed on the asset, after you've passed on the project. And if I click through, you can see here that these are also sometimes referred to as upstream or downstream carbon. So when we talk about upstream carbon, this refers to our supplier side of things. So upstream before it gets to you, and then the downstream is when you've passed it on. So when it's the client, that's the downstream side of things. If you as an organization are supplying a service or a product to a client, just remembering that downstream is the use of those products that then generate indirect emissions on that further use for it, our end user carbon. If I flick through here, you can see where you can see embodied carbon is our supplier side, our operational carbon is us as a business, and end user is our client side. An example of this altogether, if you were an organization that built and sold houses, for example, all the fuel used in the process of building those houses would be your operational carbon. All the materials you may have bought to build that house, such as timber, bricks, glass, that would be our embodied carbon. Then once you sell the house, all the emissions relating to the use of that house is then your end user carbon. So these categories all make up our organizational carbon impact, and that's how we kind of start setting the scene behind it. But I'll talk about specific scopes in a few slides' time. And there's several ways of measuring carbon emissions, but today we're going to focus on the greenhouse gas protocol, which is the most widely used. Lots of organizations use it on a global basis, and it gives a really good level of consistency when it comes to carbon accounting. This protocol explains step by step how you can build a carbon inventory, how you can undertake carbon calculations, including several examples of how you can do this. So I do recommend you have a look at the greenhouse gas protocol. And when we talk about greenhouse gases in line with the greenhouse gas protocol, it's not just carbon. It does consider methane, nitrous oxide, and all the other gases under the Kyoto Protocol. But when we do carbon accounting, we just collectively call them carbon emissions. So you only do have to do that one calculation. And in the greenhouse gas protocol, there's something called consolidation approaches. So this is where we start touching on our organizational boundaries. And this is all about defining who has the ownership of emissions and therefore who has control over them or who has to do something about them, essentially. So we have two different consolidation approaches. There's no right or wrong, and it depends on the organization. So it's split into two. First, you can see the equity share approach and then the control approach. But then this is broken down into further two, so financial control and operational control. So we have three different approaches when it comes to looking at organizational boundaries, but I'll talk to you in more detail now. First of all, we have the equity share approach. So as you can see here, under the equity share approach, a company accounts for greenhouse gas emissions from operations according to its share of equity in the operation. This is all about economic interest and how much of the organization you own. So if you own the asset, you'll take 100% responsibility for the carbon emissions because you own it. The equity share is most widely used for the likes of joint ventures. So if you had a 30% share, then you would account for 30% of the emissions. Same if you owned 50%, you take account for 50% of the emissions. Then we have the financial control approach. As you can see here, under this approach, a company accounts for 100% of the greenhouse gas emissions over which it has financial control. So let's say you direct how money is going to be sent, where that money might be spent as well, then that means you have a direct influence on how much carbon is being emitted, and therefore you account for all of those emissions. Gone back rather than forward. And then finally, we have the operational control approach. Again, as you can see on screen, a company accounts for 100% of the greenhouse gas emissions over which it has operational control. This is very similar to the financial control approach. In most cases, organizations tend to have both financial and operational control over their assets. For example, they own the assets, they have control over the operations, and they have control over their finances. So it's a little bit more straightforward. But the reason we have these is because we have loads and loads of different organizations on a global basis, and a lot will have complex structures. So they might have overseas operations, they may be part of joint ventures, for example, and that's why we have these different approaches for what's the best way for an organization to calculate their emissions. Once you've selected one, you just have to stick with that one. So it's worth considering what's best for you and your organization. And I do get asked this in my webinars, what's the most popular one? We do see the operational control one used a little bit more, but again, there is no right or wrong. It's just what's right for you and your organization. So this has been a lot to take in so far. But this is an example taken from the greenhouse gas protocol. Again, I do recommend looking through the greenhouse gas protocol if you would like more detail and examples. This example on screen shows the different consolidation approaches for one structure of an organization. So what you can see here is a fictitious company at the top called Construct Limited. This company has three arms of the business: Construct UK, I'm not going to attempt to say this one, but the business unit in Germany, and also they have this business unit in France. If we start on the left-hand side, we have Construct UK, which is an incorporated company, and you can see it's owned completely by Construct Limited, and they have 100% operational control, and they also have 100% financial control. So the chosen consolidation approach doesn't make any difference for the emissions when it comes to Construct UK in this instance. Then we have the German business in the middle here, where Construct Limited owns 80% of the business. So taking the equity approach, you would only account for 80% of the emissions from this organization. However, if you take an operational or financial control approach, they would take account for 100% of emissions, as in this case, the company has 100% control of both the operations and the finances. And then underneath here, you can see a subsidiary of the company, a subsidiary of the German business unit, and they have 75% ownership. So under the equity approach, Construct Limited, the parent company, they would take account, they would, Construct Limited would account for 80% of that 75, which is 60%. I almost said that the wrong way around. As Construct Limited have that initial 80% ownership, who then owns 75%. But again, the operational and financial control sit at 100%, so they take account for 100% of emissions. Then finally, we have the French organisation on the right-hand side here, which is a joint venture where Construct Limited own 33% of the business unit. So using the equity approach, they would account for 33% of the emissions, and this is the same for financial control in this instance, as they control 33% of the finances. However, in this instance, they have 0% operational control, and if they were taking this consolidation approach, they wouldn't account for any of the emissions. But as mentioned earlier, there's no right or wrong. You pick which suits your organization. You just need to be consistent once you've decided which one. It's also worth considering the easiest way to collect emissions, what's easiest for you and your internal teams in terms of resourcing, or how you're going to collect emissions, for example. In this instance, the operational control is quite solid numbers as well. So it's just worth considering what is relevant to you and your organization. Like I say, no right, no wrong. So now I'm going to move over to operational boundaries and scopes of emissions. You may have seen this image before, or maybe a version of this before, but this is once again taken from the Greenhouse Gas Protocol. This shows what scopes 1, 2, and 3 are. And this is essentially classifying emissions into three categories so that we can see where our hotspots are, for example. When we talk about emissions, we often talk about these in terms of direct and indirect, another term to bring in. But essentially, direct emissions are emissions from sources that are owned or controlled by the reporting company, so you as an organization. And this is our scope 1, so this bluish green arrow in the middle here. If we think back to them green arrows I showed earlier, this is that middle one, the business. This is your operational carbon. So this is emissions from combustion in owned or controlled boilers, furnaces, any combustion of fuel in our company-owned vehicles, emissions from chemical production in owned or controlled process equipment, so our plant, for example, fugitive emissions from air conditioning or heating in our HVAC systems, or the combustion of gas in any of our buildings as well. That is our direct scope 1 emissions. But then we also have our indirect emissions. So these are emissions that are a consequence of the activities of the company, but occur at sources owned or controlled by another company. So this is then split into scope 2 and scope 3. It may be a little bit blurry on screen, but scope 2 says purchased electricity, steam, heating, and cooling for own use. However, and remember this for later, when in doubt, scope 2 is electricity consumption. This is the big one that we see in here and what majority of organizations put in their scope 2. And then we have our scope 3. So this is essentially everything else. The first step when it comes to scope 3 is identifying what is relevant for you as an organization. You can see 15 different buckets scattered along these purpley grey arrows. You only have to account for what is relevant to you as an organization. So I do recommend doing a screening exercise before you start collecting your data to understand what is relevant to you as an organization. I'll talk you through a couple that we tend to see in here. So scope 3 category 1, purchase goods and services, everything you buy, all the materials that you buy, could be as small as a pen. This is where this is what we see in here, everything you procure as an organization. This also includes our water consumption as well when it comes to carbon accounting. Then we have capital goods. So anything in your procurement records defined as CapEx is what we see here, scope 3, category 2. And then fuel and energy related activities as well. This is another big one. So for any company vehicles you have in scope 1, this accounts for the combustion of that fuel. When we get to scope 3, category 3, this essentially is the well to tank emissions. So the transportation of the fuel from the well to the tank before it's combusted, not the combustion in this element. We also see waste in here. So this is any waste activities, anything you throw away, that's caught in here. Business travel, so any flying, any rail travel, any hotel stays, or any car expenses, for example, in an employee-owned vehicle. When someone is traveling for work, that's not their usual place of work, so not their commuting. It's traveling for business meetings or business purposes. Because then we have employee commuting here. So this is your employees traveling to their usual place of work, for example. And then we have all these are all these all sit in our upstream activities. And then we have all these downstream ones, which depending on you as an organization, it's whether these are relevant to you. So if you produce products that you then sell on, you'll need to account for the use of sold products and the end of life treatment of sold products as well. But again, depending on you as an organization, it's whether these are relevant to you and whether you need to account for these. You don't have to account for what's not relevant to you as an organization. A lot of the time we see purchased goods and services making up a massive portion of your footprint as well. And scope 3 can be as high as 99% of some carbon footprints, some of which I've seen recently as well, some of the ones I've calculated recently. And I've got a quick example when it comes to electricity on where emissions might fall into. So if an energy company generated electricity from gas, this would be their scope 1 because that's that combustion of gas in their operations. The householder using their washing machine, so you plug it into the socket, this would be your scope 2 because you're using electricity for your washing machine. And then the manufacturer and the retailer who sells on the washing machine, for example, that would be their scope 3 use of sold products, thinking about their arrows and where they all fell into. And this image here shows the links between scopes 1, 2, and 3 in the supply chain. So if we start on the right-hand side here, tier 0, the client. Your current impact as a company is going to be composed of your scope 1, your direct emissions, your scope 2, your electricity consumption, and also your scope 3, which will include all those indirect emissions from everything you buy from your supply chain and everything you pass on. But if you go down to tier 1, your first supplier, their impact is made up from their direct emissions plus the emissions that come from everything they bought from their supply chain, and so on and so on and so on. Goes further down the supply chain. This shows why it's really important to have visibility of the carbon embedded in the supply chain, whenever you're undertaking a carbon footprinting exercise. In absolute terms, this is the same carbon, but dividing by scope, we see who has control, where them hotspots are, and who needs to take responsibility. And it's also worth thinking about if you have a client asking for this kind of data from you, you're actually maybe their tier 1 or your probably their tier 1, not their tier 2. So it's good to understand why they might be asking for this data because they might be trying to get a more thorough picture of what their footprint looks like. It's also important to note that only one organization can claim emissions as scope 1 or 2, but many organizations can claim scope 3 and account for them. As the client, you account for the emissions from your suppliers by taking a share of their total emissions based on the proportion of their goods or services that you purchase. So to avoid double accounting, scope 3 can be claimed by multiple organizations, but they're at different points of the value chain. But to summarize, only one organization can claim emissions as scope 1 and 2. And I'm going to come back to this image I showed at the beginning just to touch on what the difference between operational and embodied carbon is. So operational carbon, which is that green arrow in the middle here, are emissions released when you as the organization are using a product or service. For example, when you drive a company car with an internal combustion engine, that's going to release greenhouse gas emissions. We also have, if you were a cement company, any of the chemical biological processes associated with that release from the process, they're part of your operational carbon. Any fugitive emissions from HVAC systems, any gas in your buildings, for example. On the other hand, embodied carbon, which is shown on the left here, are released before you consume or use that product. An example would be if you're building a house, greenhouse gas emissions were released in the production of the materials that you're going to use to build that house. Therefore, when you buy those products to build the house, such as cement, bricks, or steel, you're also buying in the associated greenhouse gas emissions. And when companies are undertaking a carbon footprinting exercise, the first focus and probably the easiest focus is operational carbon, because these data points tend to be easier to collect because they're probably in-house, for example. But for a more complete picture, or for a more complete carbon footprint, you should be including embodied carbon of the products and services you buy. However, if you've not started calculating your carbon footprint, just start somewhere. That's the best place to start because it can be quite daunting. So do that screening exercise, understand what you need to collect, then start with these data points, the operational carbon, scope one, they're in-house, easy to collect. And also scope two, yeah, electricity consumption. That should hopefully be a little bit easier to collect than some other bits. But then start building up the picture a little bit more. So think about getting business travel and employee commuting. You might be able to get that a little bit easier. And then build up the picture even more and start collecting the materials you procure, your water consumption, anything you dispose of, for example. So start somewhere and build up because it can be quite daunting and I can appreciate that. And then I'm just quickly going to touch on a couple of slides that I've got on some reporting mechanisms. There's a lot out there on a global basis, and there's a lot in different landscapes in terms of the UK side of things. Also over there in the US, you've got different things. But I just want to touch on a couple. So first of all, the CDP, which is a global environmental disclosure system that helps investors, companies, and governments manage their environmental footprints. And as you can see there, it says that the CDP allows customers and investors to formally ask a company to disclose its environmental data. And this process involves responding to detailed questionnaires through the CDP platform, and it assesses the data and assigns a score based on the company's environmental impacts and response quality. Very similar to EcoVadis from what I hear about it. But essentially, you can't manage what you don't measure, so it's worth looking into what you can do. But then this kind of looks at that investors are asking for it. They're starting to look into it a little bit more. It future proofs you against growing regulations. The disclosure rates are rapidly increasing in terms of people reporting their carbon emissions. It helps you communicate with your stakeholders and save you money, hopefully, in the future, and also can help you boost your reputation and competitive advantage. And this is what is said about CDP on their website. So I'll let you make your own opinion when it comes to reporting mechanisms, particularly if it's not mandatory. But science-based targets is another really big one we're particularly seeing on this side of the pond over in the UK. Spend a lot of my time working with clients on um, essentially developing their footprint so that they can report and validate against science-based targets. It is a global initiative and it is something we're starting to see a lot more and something that clients are asking of their tier ones and their tier twos, etc. But as you can see there, this is a partnership between CDP, the UN Global Compact, the World Resources Institute, and also the World Wildlife Fund. And as you can see there, it's a method for any organization to set carbon emission reduction targets in line with the Paris Climate Agreement. This essentially, you go onto a portal, enter your carbon footprint, and you can set targets that are aligned with the science. It helps us to decarbonize in a world that is going further beyond just what we're doing at a country level. It distills science into organizational targets, so we're able to reduce our emissions in line with 1.5 or well below 2 degree scenarios as well, so that we can kind of prevent the devastating impacts across the world. So, like I say, starting to see a lot more organizations commit to science-based targets. This covers all scopes of emissions, scopes 1, 2, and 3. However, if you are an SME, so a small or medium enterprise, it does cover scope 1 and 2 with the kind of understanding that you'll monitor your scope 3. And then it helps you to develop a plan to hit reduction targets in both the near and long term. So you set targets that are aligned with the science, but your near term is a 5 to 10 year time frame, whereas your kind of long term target is trying to hit that net zero by the latest 2050. And if you want to be a bit more ambitious, you can head for an earlier year. This does have annual reporting, and you just have to calculate your carbon footprint every year and be transparent and report this on your website as well. And this just helps set good targets for carbon reduction. Okay, I'm at the end because we've got this very exciting quiz coming up, which we're going to do. But what I'm going to do now is just have a quick look to see if you have any questions. This is a really good time before we get into the quiz just to discuss if there's anything you would like me to go back over. Is there any scopes you're a little bit confused by? Would you like me to touch on anything before we do get over to the quiz? We've got a relatively small group of us this afternoon. If you would like to no, if you'd like to ask questions, no question is a silly question before we do.
Yep, that's true. No question is a silly question. So if you do have any questions throughout, do feel free to pop them in the chat. But I think we're good to move forward, Lucy.
Perfect. I've got the Menti on screen there. So again, relatively small group of us. Do scan the QR code or I will drop the link in the chat for you all to be able to join me on the Menti. I'll also enter the code 5979211. I'll give you a couple seconds to get in there. We've got plenty of time. And if you've got any questions, please do drop them in the chat as we go, as we've just said. Give you a couple more seconds to join me on the Menti. And do not worry about getting any of these wrong. It's absolutely fine. I will talk through any of the answers as we go. For those who haven't joined yet, I have dropped the code into the chat. You can join us as we go along. We'll get started, and if anyone wants to join late, you are more than welcome to. So which scope does your consumption of grid electricity fall into? Is it your scope 1, your scope 2, or your scope 3? We're going to take the operational control approach when it comes to these answers, if that changes anything for anyone. We've got a little leaderboard as well, so get bragging rights after this. We've all gone different across the board. Interesting. For whoever put scope 2, you are correct. Remembering what I said earlier about them little arrows. When in doubt, scope 2 is our electricity consumption. Scope 1 takes into account our natural gas in our company vehicles, our natural gas in our buildings that we have control over. It's our petrol or diesel, our company fuel in our company owned vehicles. It's any fugitive emissions from HVAC systems, in our buildings as well from refrigerants and unintentional leakages. And then scope 3 is everything that's not what I've just said in scope 1 and not electricity. So scope 3 is everything else. Okay, we're going to go into the next question. Which scope does your consumption of natural gas, such as in a boiler, fall into? Is it your scope 1, your scope 2, or would this be your scope 3? You've all voted very quickly. All of you got this one, scope 1. Yeah, especially when it's one that you have control over, because we're taking the operational control approach. If you didn't have access to the boiler room, for example, because you leased out a building, this would probably fall into your scope 2. But in this instance, yes, scope 1. Next question, we've got 10, so we're on number 3. Which scope does business travel, such as by train or plane, fall into? Scope 1, scope 2, or scope 3? Someone else has joined us as well. Well done for the three of us that got that. Yes, absolutely. Remembering business travel was one of them buckets. It had its own one. I think it had a plane on the icon, and that would be scope 3, category 6. Scope 2 for that answer there. When in doubt, scope 2 is our electricity consumption, like in your buildings, for example. Okay, question 4. We have a chemical process in our factory that emits carbon dioxide as a byproduct. Which scope does it fall into? Is it our scope 1 or scope 2 or scope 3? This one might be a little bit more confusing. I've mentioned it in terms of anaerobic processes. If we were a cement company and we had them carbon emissions, where would it fall into? This one's our scope 1. So talking about earlier, I said there's anaerobic or chemical processes. If we had a cement company, for example, that would be our scope 1 emissions. We have that full direct impact on them emissions, for example. Scope 2, when in doubt, that's our electricity consumption. So go plugging into the grid, for example. And then scope 3 is everything else not mentioned within them ones. Scope 1's that natural gas, it's that fuel consumption in our vehicles, it's fugitive emissions from HVAC units, and it's also the chemical processes, anaerobic processes if we were a cement company. But I appreciate we might not all work for a cement company, so that one might be a little bit harder to understand where the emissions fall into. Ooh, we've lost someone in the process. We'll keep going. We buy in and use a lot of materials like concrete and drywall. Which scope do they fall into? Scope 1, scope 2, scope 3. Keyword here is we buy in and use a lot of materials. We buy in. Scope 1, Scope 2, or Scope 3? Yes, it's that Scope 3, that purchase goods and services, because we buy in the materials. The thing that was throwing you off here was that word concrete, because I've talked about if you were a concrete or cement company and then chemical processes. But the key word there is that we bought it. We didn't create it ourselves in this instance. We're going to have a halftime leaderboard. Simba is leading the way, closely followed by James. But it's anyone's game still. Simba and James might get the questions wrong. We've definitely lost some. Oh, we're back. We've got the fourth person back again. Right, second half gets harder this time. We've commissioned and handed over the asset to the client. They determine how much energy is used in running it. Which scope is this? Scope 1, Scope 2, Scope 3 upstream, Scope 3 downstream. So we've handed it over, thinking about that. So it's that end user carbon that we talked about. Try not to give anything away. Well done. Absolutely. You remembered the upstream and downstream side of things. The bit that throws people off is that energy consumption bit there, but you've all got this one. Scope 3 downstream because you've handed over that asset. Maybe I'm making it too easy by giving you some hints. Or you just all know. You do really well. We get our HVAC system checked and topped up every so often. Which scope do these fugitive emissions fall into? Is this our scope 1? Is this our scope 2? Or is this our scope 3? I've mentioned this one a couple times. Yeah, good job. This is our scope 1. I mentioned this one a few times. Remembering that's where it falls into. Scope 3 would be there's other different buckets, but in this instance, the top up of HVAC systems, heating, ventilation, and air conditioning falls into our scope 1. It's them unintentional leakages of greenhouse gases. 3 more to go, and we'll see who's got the bragging rights. We lease some of our assets to tenants who then run and control the facilities. Which scope do these emissions fall into for us? Is it scope 1, scope 2, scope 3 upstream, or scope 3 downstream? So we lease some of our assets to tenants, so similar to handing over the asset, and they then control it. Yeah, well done. You've got this absolutely right. It's the same as handing over a product to a client and selling it on and having that use of sold products. In this instance, it would fall under Scope 3, Category 13, downstream leased assets for us. And when we start accounting for downstream leased assets, we take into account the customer Scope 1 and 2 within our Scope 3. So remembering that we don't double count our emissions, only one organization can account for Scope 1 and 2 in Scope 1 and 2, but their scope 1 and 2 would fall into our scope 3 category 13 in this instance. Oh, we've lost someone again. A couple seconds. We'll just keep going. You can catch up. We use waste services and consume water. Which scope do these emissions? Which scopes did the emissions from these services fall into? Scope 1, Scope 2, and Scope 3. Water consumption used to be the one that first confused me when I got into carbon accounting, as it has for some of you. This is the one that used to confuse me as it's a utility, but it is scope 3. So water falls under scope 3 category 1 because it's an indirect emission. Someone else has control over it and you buy the service. Waste as well falls under scope 3 category 5, so our waste disposal falls in there. So these are our scope 3 emissions. Scope 1 is our natural gas combustion in our buildings when we have control over the boiler room, for example. And it's then refrigerant and fugitive emissions that we talked about, company fuel, and any chemical processes, for example, fall under Scope 1. It does not include waste and water. And then Scope 2, when in doubt, is our electricity consumption in this case. So for whoever put Scope 3, well done. You are absolutely correct on that one. And final question of the quiz, and then we'll see if Simba held onto it, onto the lead. One of our facilities is leased from a landlord. We control how much gas we use and we pay the bill for it. Which scope is this? This is going to be a confusing one. Sometimes catches people. Scope 1, Scope 2, Scope 3 upstream, or Scope 3 downstream. No one got this one. It's Scope 1. The way it's worded is intentionally to try and confuse. Yes, we lease the asset from a landlord. However, we control how much gas we use and we pay the bill for it. When we spoke at the beginning, this is talking about our operational control over this. We have control over getting to the boiler room, for example. In this instance, we control the gas consumption. It would be our scope one because we have full control over getting to the boiler room. We have full control over turning the gas on and off. That would be our scope one. There is instances where it could fall under scope two. So in a way, this one could be correct, but it would fall under scope two if we had no control over it. So it's we use gas, but it's we can't get to the boiler room, for example. In this instance, we can control how much gas we use, but it would be scope two if we just turned the heating on and off and we didn't have access to the boiler room, for example. And it's not scope three upstream. Again, there is a kind of a smaller loophole where it could be scope three upstream, but mainly if we were using a different approach. So if we were considering the financial control approach instead, or the equity share maybe, but more so the financial control, there is a category called upstream leased assets, but this is when we don't account for the emissions in scope one and two. And again, it's not often used in the operational control approach. And in this instance, the questions were aimed in an operational control kind of lens. Hopefully that all makes sense. There's different ways when it comes to carbon accounting, and it can be confusing at times, but hopefully I've made that all make sense and scope busted a little bit today. Didn't give us an update on the points, but well done to Simba. You get the bragging rights for today because you've won our quiz. Unfortunately, I don't have a prize. You just get to say you won my quiz today. So that is the end of our session in terms of the content for today. But what I want to quickly do before we close out, and if you have any questions, please do drop them in the chat because now's our time to answer them. We have about 20 minutes. I just want to recap on the scopes of emissions because this is what we're all here to talk about today. As it says here, direct emissions are emissions from sources that are owned or controlled by the reporting company. And when we think about this, it's company-owned vehicles and the fuel that's combusted within them. It's natural gas in our buildings, but when we have access and full control over them in that instance. It's if you're a cement company, the anaerobic processes, because I know we have different companies joining us today. And also it would be fugitive emissions from the likes of our HVAC systems when we get them topped up. It accounts for them unintentional leakages in that instance. Scope two, when in doubt, electricity consumption. And then scope three is everything else that isn't accounted for in scope one and two. So it has these 15 different buckets. And what I recommend is going away and doing a screening exercise or looking to do one and just kind of starting to account for what is relevant to you as an organization. Because if you don't have investments, you don't have to account for investments, for example. But don't be scared when you start carbon footprinting or you see your carbon footprint when scope three makes up a big chunk of this because purchase goods and services tends to take up a big chunk of it. But again, depends on the organization. But we have all these ones that we commonly see. So scope three, category one, purchase goods and services. Scope three, category two, capital goods. Three, fuel and energy related activities tend to be relevant. Waste, category five, business travel, category six, and employee commuting, category seven. They're the ones we tend to see in most carbon footprints, but then it extends beyond this depending on you as an organization. And like I say, this brings me to the end of our session. Please do provide your feedback on, again, if there's any sessions you want to see in the future, because I appreciate this. We only get an hour together to talk about scopes or carbon, for example. So if there's anything you want to see in the future, let myself know, let Wendy know, and we can look at putting that on for you so that you can learn a little bit more about carbon. But also now we've got, like I say, I think we've got just under 20 minutes now to answer any questions. So please do ask them or put your thoughts in on if you have started your carbon footprinting journey, how that's going. We are more than happy to answer any questions. And Wendy would be happy to answer any school questions as well if you have them.
That's right. Yeah. So, yeah, really good point, Lucy. If there's any challenges that you're facing, maybe you're progressing on through your carbon reporting journey and you're experiencing challenges, or maybe things have been a little bit easier for you than you thought they would be. Would love to know where you are in that process. If you have anything that you'd like to share with the other attendees. And I will also remind you that if you have any questions that, crop up after the session, happy for you guys to reach out over email and I can make sure that Lucy gets your question. But yeah, thank you, Lucy, for a great session. And yeah, congratulations to Simba, whoever you are. I always love doing this quiz with you, Lucy. I always laugh because this is obviously not my first rodeo. I've been on these sessions before, and every time I get a question wrong, I'm like, come on. So It is
I
a
do
it's
have to say, to beat Wendy is a good feat because, like she says, she knew the questions and still got the answer wrong.
I've had yeah, I've been through this before, so I'm not cheating, obviously. I know the content, but yeah, I do have a leg up. All right. Well, I think if there are no questions in the chat, I think we'll probably wrap it up. We'll give you guys some time back. Like I said, I will be sending out an email with the link to the recording and the slides. If you do have any questions, just reach out. Happy to answer. Make sure Lucy gets your question. And I will also remind you that this is, as Lucy said, we don't just run this session. We run many other sessions on a variety of different sustainability topics. It's not just carbon, it's not just waste, it's also forced labor, it's community engagement, social value. So do check in with our event calendar. We're always adding new events, so would love to see you at a future event. So I think I'll just end by saying thank you to all of you for attending. Really appreciate you guys taking the time. And a huge thanks to Lucy for a wonderful presentation. Thank you, Lucy.
Thank you very much, and thank you everyone for joining, like Wendy said. And you can have 16 minutes back of your day.
Hey, that's not nothing. I can get a lot done in 16 minutes.
Perfect. Thank you so much, everyone. Have a
Thanks,
great
everyone. Enjoy
day.
the rest of your day.